We are delighted to welcome professional trader and president of LBR Group, Linda Bradford-Ratchke. In this session, Linda will discuss how you can narrow your focus down to one primary trade concept and eliminate the ever-increasing noise. Linda, thank you for joining us today.
You're welcome. Am I ready to go?
You go ahead, take it away.
All right. I wanted to start off by saying thank you to the folks at the MoneyShow for sponsoring these webinars, which I understand are archived for free. So there's a wealth of information for those to go and review at later points in date. And hopefully this webinar will be archived as well. First of all, let me start off by saying that this is a perfect time to be doing this type of summary because I formally resigned as being a CTA and a CPO of my hedge fund at the end of the year, and so therefore it's sort of semi-retirement for me, which actually means that I have the full luxury of trading 100% for myself as opposed to always trading for the fund and having other obligations such as NFA audits and fund accounting and so forth. So that really allowed me the opportunity over the last month or two to sort of digest things and look back through all my notebooks and try to summarize what really worked best for me over all the years and what perhaps is transferable just to a few key points for people that they can take home with them. And first off, let me start off by saying that the markets on one hand are exactly the same in terms of my methodology as they have been for the last 35 years. But on the other hand, there have been some significant changes with the advent of electronic trading and higher time frame players and much more diversity of players on multiple time frames in general. And what that tends to do, this is all lifted from Perry Kaufman's work, a researcher I greatly respect and admire, is that it increases the noise level. And so what that means is that you have a lot more back and forth during the day in certain markets that may appear pure noise spikes and without much meaning. And a good example of some of these markets are the gold and the silver and at times the nat gas and crude oil. And I'm sure all of you have witnessed these things for yourself. So with that increased noise level, I see people still very strongly bent on this notion of pure technical trading, okay, which on one hand we're technical in the sense that we are trading off price and very conscientious as to what the price is doing in terms of is there an increase in momentum or a decrease in momentum, and where are significant support and resistance levels and so forth. But on the other hand, I am skeptical that a day trader can make a healthy living off of pure chart technical trading 100% of the time. And the reason is because the technicals are a bit more awkward on the shorter time frames when you do have this increase in noise level. And you know, it's nice to say, oh, look for the momentum sell divergences or buy divergences or just simply trade the continuation flags or patterns. But if you've been actively trading in these markets, you well know that you might only get those types of pure clean setups maybe just a third of the time. And it's very easy to get tripped up in the noise otherwise. So I think that we need to reach beyond just the pure technical chart trading. And so I wanted to take on the topic of, number one, summarizing what really has worked best for me over all the years that has not changed. And then number two, just a little bit of digression here as to the pros and cons of, is it better to have perfect trade location, or is it better off to get the main idea right? And by prefacing that, let me start off by giving you a little analogy here that came from Rick Jeanette, who was my first real right-hand man when we started managing money in the early 90s. And Rick came from a trend-following outfit, Show Inc., which was one of the original Turtles. And as you know, the Turtles are trend followers, and part of their methodology relies greatly on breakouts and so forth. And so Rick's comments were, when you are in an urgent market that's moving or breaking out, the whole point is to get the trade on. All right, so by get the trade on, that may mean entering at prices that you may not deem quite as advantageous. You may not get a little pullback to enter. It's more important to get the trade on as the train is leaving the station. So you may be sacrificing what might appear at the time as a little bit of trade location. Now, one of the things that trend followers do, and what we do in our modeling, is to test for the duration of the entry window. And this is just, you'll see how all this is going to fall into place. So for example, if I'm backtesting a trend following system, I want to know, how does that system perform if my entry is 24 hours later? Okay, so maybe I don't enter at the perfect spot. I don't want a system, a trend following system, where 80% of the profits are made in the first 24 hours. You see? So that wouldn't give me a whole lot of confidence. I want to see that there's a duration of this profitability of the good trades. So therefore, in an urgent and breakout type of market, the trade location is not as important. It's a matter of get the trade on, and that would be an example of get the main idea right. Okay, so the main idea is that the market's breaking out, there's urgency, there's a strong shift in the supply and the demand, and in theory, it really shouldn't matter where you put that trade on, over a 15-minute window or an hour window, or even if you're a billion-dollar fund moving currencies, hopefully over a 24-hour window. Now, most of us don't have $1 billion that we're trading, so our window of entry might be a little bit smaller. Now let's just look at the flip side of the coin. Here's another great story by Simon Townsend, who is a fund manager over in London, who's a very good friend. And he gave a great story about, this is, I don't know if it's a true story or not, but it's supposedly a true story about the prop trader at a Swiss bank. And you know, they bring them up through the ranks, and they'll bring in a class of 10, and then if they're seasoned, they're cut down and only 4 make it, and so forth and so forth. This is a very common process if you aspire to be an institutional trader. They'll start with a group, they'll train them all, and then they weed them out, and it's a case of Darwinism, if you will. So one of the newer traders there was about to get weeded out, and he got a second chance, and was about to get cut again, and he said, wait, give me one more chance. And he came back, and he had taken a month off to really think things through, and he came back, and lo and behold, he was just trading one currency there. He did so amazingly well that he all of a sudden had 4 people underneath him. He made fabulous monies over the next 8 years and retired, and everybody wanted to know what his secret is. What was his magic system where he was doing such profitable trades? And again, I don't know if this is true or not, but it illustrates a very pertinent point that is the flip side of the other example I just gave you, and that was he would hop on the train every morning, and there was a little cartoon in the newspaper that he would see. And in that little cartoon, there was a character that was holding a sign, and sometimes the sign would say one thing, and sometimes the sign would say the opposite thing. So his system was, if that sign said, look this way today, he would only trade from the long side, and vice versa. If it was the opposite thing, he'd only trade from the short side. So the point is that he had a random generator to tell him whether he was going to trade from the long side or the short side that day. So right away, one part of your decision-making process is alleviated for you. You can only trade long or only trade short. And what that forces you to do is be very attentive to your initial trade location. And if you were working for me and I told you that you can only make trades from the long side today, and the market was trending and going higher, you'd feel very confident, buying dips. You'd be watching the tape and feeling right in sync there. And if the converse was happening, let's say, for example, that the market was selling, you'd still be very, very attentive to looking for the price action to slow as it's selling off, perhaps show a little bit of support. And I guarantee that you would be able to make a small trade or a scalp from the long side, even on the worst trend day. I've seen people do it, even if it's just 2 ticks. So in that case, your trade location was most important, aside from the fact that you didn't have the main idea right, but you're focusing on a different type of technical trading. So there's 2 sides to every coin. The first is getting the main idea right, which is what I'm really going to talk about today. And the second is being very, very careful and attentive to your initial trade location. Now, what I see is most day traders are extremely careful, at least the ones that are still around, about their initial trade location. That's why they're day traders, and that's what they're focusing on. And I'm sure that all of you have certain little tricks, such as looking for a little 5-minute buy divergences at the end of the morning trend down for a little scalp to the long side, and so forth and so forth. Now, you can definitely have a lot of success with being purely technical like that, but what tends to happen more often than not is the trader starts making too many trades during the day. Think about that. How many times have you started out trading and you're up for the morning, and then you start to get a little tired, and you know, maybe your tape reading skills are a little bit more marginal, all right? Or perhaps you were out a little bit too late the night before and you make an impulsive trade that you didn't mean to make. Or you had a fight with you know, your best friend or your spouse, and you're not in the best of moods, and you make unforced errors. So my point is, both sides focusing on pure trade location and being very attentive to the slowing of price or looking for your entries can be profitable. It's a lot more dependent on your physical and mental state of mind, okay? Because there is room for more unforced errors. And every sport, you know, has unforced errors. And unfortunately, in tennis and in golf, if you take a mulligan or an unforced error, it doesn't hurt your bottom line nearly as much as unforced errors in the markets do. All right? So what we're going to focus on is, I'm going under the assumption that most of you are pretty good at tape readers by now, and pretty good at reading the charts and so forth. So that will give you just a little bit of extra added edge in getting this main idea right. All right? So what I'm going to concentrate on is strictly centering around the idea of basic supply and demand. And the main idea right for me is trading in the direction of the trend, all right? And we're going to qualify that and say trading in the direction of the trend for the day, all right? So what we're going to do is we're going to use the movement off the 7 a.m. price, Central Time, so 8 a.m. if you are on the East Coast. I was fortunate to be spending most of the winter down in Florida this year, first time in quite a while. And I have to tell you, honestly, I must be getting old, because I can't tell you how tricky it was for me to switch back and forth with this time of day function, which I'm so keenly attuned to now. You know, is it really 11 o'clock? Is it 11 o'clock Central or Eastern? So just again, for the purposes of this presentation, we're going to be strictly looking at that 7 a.m. reading. Now, right up the bat, up on my screen here, I've got a 5-minute chart of crude. And here's a this is a 15-minute chart. And you can see pretty much the big movement to the downside, okay? And we're going to get into predicting the direction of this of the trend for the day a little bit later. But worst case scenario, if you come in the morning and you're caught a little flat-footed, simply take this 7 a.m. reading here, and for those of you who are proficient in market profile, you can also think about that concept of the initial balance, meaning the early rotations for that session. I divide the day up into 3 main sessions, actually 4. Evening session starts with Asia opening, European session, and US session starts at 7 a.m. for me, and then there is the afternoon session, which may or may not have some significance. So each of those, you can look for the trend during that time period to trade off of. obviously with this chart of crude, you can see the main idea right here, 7 a.m. reading, big trend down. And there's our daily candlestick bars right here. All right. And again, 7 a.m. reading, big trend down, little back and fill there. And you can see today, what do we have? Even though we did do the test of the previous day's low perfectly at 7 a.m., we have been trending solidly up off of 7 a.m. reading, meaning that we never really traded below that initial 5 or 15-minute bar. Now, I want all of you to think about if you only could take trades in the direction of the price off that 7 a.m. reading. So, in other words, if the price an hour or two later was above that 7 a.m. First 5-minute bar, and you only could trade from the long side, in other words, not taking any cute counter trend trades, which could be valid in their own part, how many unforced errors would you eliminate from your account? Okay, so a lot of times in our trading, which by the way is not necessarily based on our skill level, it's based on our ability to manage our trades. All right, so to be a good trader, it's not a function of IQ, and it's a function of your risk management ability, and then just being a little bit more aggressive at certain times. Nobody is expected to read a chart correctly 100% of the time. All you need to do is find one spot in the direction of that main idea. So for starters, we're going to define the trend for the day as the movement off of that 7 a.m. reading. All right, the next thing I want to go back to time and time again are the concepts presented in Taylor. And if I had to grossly oversimplify this, Taylor's simply looking for a reversal of high to low or low to high from the previous day. And with a caveat saying when you break from a line, very important to read Taylor's words correctly, when you break from a line, the market can move 5 days in one direction before you then look for the buy day. So it's not just as simple as switching from low to high or high to low, but also understanding when you break from a line. Now this is CQG, but you can do this with something similar in TradeStation and a lot of charting programs. And over time, you can train your eye to see the same thing anyway. I'll show you how to do that. But this is a volume histogram here, all right, which simply shows the volume over the previous 10 trading days. And if we were to squish this up a little bit even more, you can see your eye, you can take your eye and just any place that you can draw a horizontal line through multiple bars is going to be your volume spike for that day. So back here, right through the middle of there, I had that big volume node, if you want. So when you push out of those nodes, you get these breaks right from there, and you can see the impulse to the downside. Those are the places where you want to be careful and let a trend run its course. It's no more than saying there was a breakout from a chart formation, and as long as the market is indicating some type of momentum in that direction, then you can look for the continuation patterns. So I say that first to preface the fact that really Taylor emphasizes looking for the buy day and the sell short day. Now what does that mean? That means simply that you're looking for a reversal of the previous day's action, and ideally, if you are lucky, you catch an increase in volume and enough range expansion where you can then hold that trade overnight. And what that does is that keeps you playing in the direction of that trend for the day and not making a scalp trade where you end up leaving most of the money on the table because it was too easy to take a profit in the middle of the day. You see, so if we start back and say, what is the main idea here? The main idea is looking to initiate a trade that has a change in direction or a good enough breakout or increase in momentum that you can then hold it overnight and exit it the following day. Whether you choose to do that or not is a different story. If you're a day trader, you may want to exit by the end of the day, but at least it's going to keep you for playing for a little bit more duration and not getting too cute and taking your little profits off that 5-minute chart too soon. So let's just go back again, and there's 1 or 2 more ingredients with this trend for the day. Several things that I've always looked for with the Taylor concept that can dovetail right into this. And by the way, if you were to do a homework sheet, and for every market say, I'm looking for a buy day or I'm looking for a sell short day, and of course you have some middle days in between too, where they're sort of consolidation days. All right, I bet that you will get it right at least 65% of the time. That's better than most mechanical systems. And if you don't have it right, then obviously you'll know pretty quickly. All right, but 65% of the time is better than 50% random generator. You can only trade from the long side and you can only trade from the short side. Now let's back up one moment and remember that trading is just probabilities. Nobody out there can forecast with any degree of significance, forecast the price correctly the majority of the time. It's not about our ability to predict where the market is going to go. It's about our ability to follow the price action and hopefully in the direction of that increase in volume and that range expansion. So let me show you, I'm just going to back up here and show you something kind of cool. Where's my little page here? This is actually my main page that I've got on one of my monitors that I keep up all the time, and I've got the time of day functions marked off. Now, in doing preparation for this, I didn't want to cherry pick key days, so I thought, well, let me just simply see where the chips fall, and then we'll see what the trends were for the day around that 7 a.m. opening. Aha! Well, there's a caveat here. I forgot that it was pre-FOMC. So the last ingredient here, in addition to trying to forecast whether we should trade from the long side or from the short side for the day, okay, which is different than saying price should go here or price should go there. You see what I'm saying? So we're not predicting where the price is going to go. We're just going to try and see if there's either a change in trend from the previous day, allowing us for new entry, or if we can get some good movement off that 7 a.m. reading. But there is a caveat, right? Every rule has its filters, and the last filter is volume. Now, a long time ago, I did a lot of work on trying to predict volatility conditions. In other words, are we going to have volatility expansion or contraction? Are we going to have an increase in volume or a decrease in volume? And honestly, I found it much easier to model the price than to model the volatility, even though we can come up with setups such as an NR7, or for example, here was a nice little flag in gold that came up. You can see gold here has, this is just a daily candlestick bar. I like the candles for the daily action. For me, it just gives a different feel than the straight bars. Okay, so you can see here there's a little inside range day, 3 bars overlap, nice tight, and normally that's one of the things, mind you, one of the things that can lead to an increase in range. See? So for example, you see right here, 1, 2, 3 with 3 narrowing bars of range, and you get your expansion day, right? So same thing here. You've got 3 little narrow ranges, and you get your expansion day. And you can see that time and time again until you actually go to apply it to real life, and you're going like, why am I getting chopped up today? What is happening? So a lot of times it doesn't necessarily guarantee you're going to get a breakout, but the factor that you need to look at is volume. And I have found no better proxy than simply looking at the first 30 minutes of NYSE volume. Now, how can that possibly be relevant? Because we all know that less than 30% of all the stocks traded on the New York Stock are on the New York, are listed on the New York Stock Exchange. That most of the trading takes place on other exchanges or other venues and so forth. Their market share has totally collapsed. So why would that be of value? Well, it has to do with the overall market conditions and psychology. And obviously, if we look at today, you can see this is the first 30 minutes of today, and we've got the lightest volume in ages. Why? Because it's FOMC. So of course, that's a no-brainer. But for me, I found it more significant to look at the first 30 minutes of the NYSE volume as opposed to looking at the volume in the S&Ps or the spiders or so forth or so forth. This is still what works best for me. And keep in mind, you guys are attending my Trading 101 class, which is titled KISS, Keep It Simple, Stupid. So I'm a person that's a 1 mouse click person, a 2 indicator person, and 1 glance person, and this is Keep It Simple. Okay. I'll be with you in just 5 minutes here. Okay, I'm going to move my boxes. Okay, and then come back. All right, so do see if this works for you. I found it very significant in terms of when there is big movement and so forth. Now, for example, with gold, if we were to sit there and look at what happened, oh golly, when was it? A week and a half ago, you had a pretty good breakdown here. I don't know why people are obsessed with gold. It's really not been the greatest trading market. It seems like all that glitters is gold, but people seem overly concentrating on this market. I'm not sure why. So this is March 6th, and what I want to show you is if we go back here, here was March 6th. So you see, obviously it could have been an ECB meeting or some other event, but right away you can see the volume showed up, huge volume in that first 30 minutes in the NYSE, right? Now, what happens, you say, what happens if you come in the morning and the price has already moved overnight? Very valid question. Well, let's just take a look and see what happened on March 6th, because there is an answer for everything. You can see this was our 7 a.m. reading on March 6th. So very strong urgency, new momentum lows on that 5-minute. Probably any time frame would have been showing you similar types of things. I won't belabor this here. So just to sum up so far, we're looking at trend for the day. We're looking at, is there an increase in volume? And we're looking at, if there is an increase in volume, is it a first day from high to low, meaning a true breakout? Or is it coming later in the move? In other words, if it's the second or third day down, it's probably not going to have the same power. It's not going to be the same type of Taylor trade. Now, I want to go right back to that crude chart that we were focused on, because there's several other things that come up for me all the time. Pardon my clicking the screen around. I lost my main page here. There we go. Any one will do. Here's another question that always comes up for me. All right, this is always for me. And you know, anytime I talk to you guys or you know, give my thoughts, what I'm really doing is I'm always talking to myself. Okay, it's what happens when you sit in front of a screen by yourself for too many years. You know, you start talking to yourself. So the other question is it better to really concentrate on the daily charts for your main direction and look for those key daily signals? For example, let me show you with this copper chart. Here's one of my choice. I used to love looking for these little 10-day window buy divergences. You see, I take the new momentum lows on the oscillator, and you count 10 to 12 days over, and you start to get your little buy divergence, right? Very, very pretty. Looks great, right? Looks great. Look at these bonds here. Here's another one. It wasn't quite perfect, but the same type of buy divergence, if you will, in this case, into a weekly pullback. So these things are all really important to be aware of. But what is the problem with this? The biggest problem is going to be the frequency of occurrence. All right, you're not going to get that many 10-day buy and sell divergence windows. In fact, I usually find that I'm lucky if I get one a quarter, you know, and then the risk is that in the meantime, you end up getting chopped up in a lot of mishmash and noise as well. Now this is nat gas. That's I was just putting up something different there. So we can see big picture the line that's forming here. All right, this is a really powerful line. It's very eventually this is the type of formation that could lead to one of those trends up out of that big volume node, right? But in the meantime, it's very difficult for a trader who's on a 2 to 3 day time frame, let alone a daily time frame, you know, an intraday time frame to deal with. So you need to be aware of the dailies. I find that the chart formations off of the dailies have a lot more noise, a lot more false breaks up and down, and I've really come back time and time again to that 2 to 3 day type of Taylor rhythm, where I'm simply looking for the 120-minute, 240-minute to sort of confirm what we're going to see in our daily candlesticks. So the euro currency here, we can see big picture after the fact, this sideways line that formed here, all right? And I think everybody was looking for the euro currency to break to the downside, but when is it going to happen and how is it going to happen? And you can see how much noise you had. You had about 7 or 8 days of choppy, whippy, chop, chop, back and forth. And again, these little funky things here. So a lot of methods look great in hindsight. These are the things that the authors pull out of the textbooks, and you know, it's like, oh, it looks picture perfect. Just simply trade the continuation to the downside. But if you're a short-term trader, it's not always so easy. It's the noise and the intraday, you know, Draghi speaking, this, that makes it more awkward. And truly, you have to understand that if you want to capture these types of extended runs, is what I call them, and that's where you can see we've got multiple closes on one side of this short-term moving average here, you need to be trading a methodology in a very methodical way across multiple markets and understand that there's going to be a lot of false starts and false breakouts, and it's much more of a very systematic approach. And then you'll be able to capture these types of things more easily. So don't ever say to yourself, oh, gee, I had a great short on, I didn't stay with it, or I got out too soon, or so forth. If you were able to at least capture a good part of the trend for the day. So my system that I trade would go short on a day like this because you have this breakout from the 3 bars, strong trend down after the 7 a.m. reading, which tells me hold overnight and play for follow through. And I would have gotten out on this day here. I would have closed it out and said thank you very much. So I can't sit there and whine and say, oh, gee, I knew they were going to flush it down towards the big round number. Oh, you know, eventually it's going down. You can't do that to yourself as a trader. You need to sit there and play a very consistent game. I can't emphasize that point enough. And that drives us back home to the original thing that I was talking about earlier, where people are doing technical trading and trading off the charts, and they might have 1 or 2 great trades that they cherry pick off perfectly in the morning session, but then they start to get sloppy. You're trading too many time frames, too much diversity, and it's going to backfire on you. Now, if you'll start making unforced errors, and that's the real danger, you see, is knowing ourselves and what type of method we're prone to get sloppy on. Now, I'm going to give you a fabulous example. If you'll stick with me for just 1 minute, I have to get step out for 1 second. I'll be right back. My purse is upstairs. Do you know where my purse is upstairs? Okay, for those of you who trade stocks, I'm going to give you another illustrative example. And this is from a friend that I've known for, 25 years. And he really puts his money where his mouth is. Great example of somebody who knows his game, and it's in part exploiting this range expansion trend for the day and holding overnight. He doesn't even use stops during the day, and exiting on the next day. And I originally met him because a friend had given me his volatility breakout system that he had developed in 1992. His name is Bob Buran, and he actually published all of his trades for an extended period of time. And he still is doing the same thing today, except that he is doing it with stocks. And I'm going to show you something amazing. Okay. Oops. Fill it in for whatever. You're wonderful. Thank you so much. Okay. I love you. I'll be calling you. Okay. So Bob Buran, you can actually Google. I'm going to do this for you because it shows how committed you really need to be to your style of trading. And this is what I see people not being committed to their style of trading, not understanding the power of range expansion. And you can do it for yourself. If you just Google Bob Buran stock twits, you will see that this fellow still posts all his trades every single day. He is legitimate, and you'll just get a kick out of this. It makes me grimace sometime. So here you can see his website. I'm not promoting Bob, by the way, and I'll tell you a very funny story. Okay, but you can go and you can see his track record for every single day. He posts his trades, download all of his performance, and so forth and so forth. And not only that, you can buy his system for $1,000 and find out exactly what he does. And I will tell you that he trades it almost exactly verbatim. Now, here's the funny thing. Bob has been selling the same system for 20 years. And he told me, you know, he knows that he can trade it and he will always do it. He made a couple $100,000 last year and a couple $100,000 the year before and a couple $100,000 the year before that. You can see it. And there's some wild drawdowns in this account too. I mean, I won't make light of it. You know, you can be up 20% and down 20%. But he says 99% of the people that buy his system cannot trade it. And it is the simplest system in the world. And this is the problem with buying another person's system. You don't believe in it because you didn't do the work. So my point is that anything that you borrow online or somebody teaches you, or I can sit there and espouse all day long looking at breakouts from little 3-bar coils, but trading is a game of probabilities and statistics, and every system methodology will have drawdown times, will have flat times, will have noisy times. And even with the Taylor, you know, for years I do this buy day, sell short day. And what you're really playing for is that one big, glorious trend day. Perhaps something like this bar here, where we had our buy day. We had 2 days where we were sold off and left a nice little tail. Perhaps this was our buying day because this was our sell short day, and we bought the flush down below the previous low, right to that moving average perfectly. Okay, and then we exited our long perhaps on this day. It's not a perfect system. It's not a perfect model, but it is just a model. Okay, so I'm just hypothetically here. And then what you're really playing for is with any system, you are going to get that one glorious day where you have that increase in volume off that 7 a.m. reading. The price never looks back off of that 7 a.m. reading, you see, and so forth and so forth. So no matter what style we're doing, I know that maybe only 10% of my trades are going to be big wins, and maybe the rest of the time I'm trying to scrape out something in the direction of the trend for the day, and a lot of times it's marginal, or there might be small losses or little aggravating periods where I don't really get much of anything at all. So this is back to our little 5-minute thing. I wanted to plot a little. It doesn't really matter if you have a stochastic to help you. I put a stochastic up here, or the 310 oscillator. My main point in showing those is pick your tool, pick your poison. Honestly, a good chart reader can do without those, and it's more a matter of getting that main idea right off of the opening price here. Where did you can see I've got a lot of little ways of looking at this here. A lot of little displays. Let me get back to my main one here. Okay, but I've talked a lot, and I want to see if we've got questions right off the bat here, because you guys have the benefit of me being able to pull up any chart, any stock, any time frame. Before we do that, I just want to summarize here the main ideas. First of all, volume. Any method works great when you have an increase in volume. All right, that means that there's strong supply-demand imbalance. When you have an increase in volume, the majority of the time, strong supply-demand imbalance, and that drives price. When you have the increase in the volume, you've got continuation patterns are easy. When you have the decrease in volume, for example, let me show you a great example with this gold. We've had very, very light volume today, and if I sit there and I put up this chart of gold, here's our 7 a.m. reading, but it's not going to be continuation patterns. It's going to be spaz and noise, because there's not the main driver. And I do see all the time the little algorithms in there goosing the price a little bit more than it would have gone in the past. So there are little systematic algorithms that can sit there and run the price to extremes that we didn't see in the past. And I don't think it really means anything. And they make a very, very small amount of money, because, trust me, they do get chopped up too. So be careful when you see those goosings not to read too much into it. There's a great adage, okay, if you think about the price equals time. So if the bigger the range up here, remember Gann always used to draw his 90 degree angles and so forth. So if it has to consolidate an equal amount of time, and in this case, it definitely was a little algorithmic noise goosing, and it probably got a little bit more extreme just because you you tested that key low there. So there are algorithms out there that will sit there and if the price reverses off of a test of the low a certain amount, they come in and they simply trail a stop, and they'll get out when the market backs off against them. So,
Hi, Linda.
okay, I'm trying to figure out where I go to see if there are
Linda? I'm
Yes.
going to go ahead and read them to you. Actually, a couple people are asking this similar question. If trading stocks, do you suggest watching stocks pre-market open or use a different time to start instead of 8 a.m.?
Actually, there's a great case again where it's the urgency off the opening price is greater than before, than ever before, and so many times you see most of the move driven in the first 30 minutes. So I don't look at the pre-opening, and the reason is some stocks are very active pre-opening and some are not. So there I just simply use the 8:30 reading, or rather the NYSE opening. And I love TradeStation because of their radar scan. And I think that most people have caught on to this. It's nothing new. Just simply if you're looking to scalp, looking for the stocks that are up the highest percentage in that first 5 minutes or that first 15 minutes, I actually do a little scan where I'm looking for what has moved the highest percentage in that first 15-minute bar. So not necessarily relative to the previous day's close. I take today's open and what has the biggest percent move off of either that first 5-minute or that first 15-minute bar. Now, if on top of that you can add an increase in volume that you would see for that time period, you can get like an 85% win-loss ratio looking to get on board pretty quickly. Now, the tricky thing with these types of stocks and these types of moves is that back to that little algorithm that, you know, the best trades are get the trade on. You may or may not get a little 1 minute or 2 minute or 5 minute pause to enter. So do you just start buying at the top of that first 15-minute bar or that first 5-minute bar? Do you average in most cases, which will be like adding to winners, hopefully. But that's the tricky thing there is the initial trade location is going to be much more awkward, but instead you're getting the main idea right, that there's a very strong urgent demand or supply imbalance with that particular stock. So today is kind of a funny day because we've got FOMC and overall not as much, but right top of my list on my database, which I only keep about 250 stocks on my database, top on my list today was BTU. So I'll put that up here because actually this is CQG, so it has a little bit of delay, but BTU was top on my scan today, and let's just take a look and see what that did.
Hey, Linda, can you also just reiterate what time zone you have been talking about here?
Yes, I'm going to refer everything to the Central Time, okay? So
okay, and Linda, go ahead and finish up on that. And just as a closing, because we're up on time, is I do have somebody inquiring as to if you'll be teaching any online courses.
Okay, so here you can see BTU. This was top of my list today for the initial range expansion or that initial good 15-minute bar, and you can see here it had this is again a little bit delayed, but here was our opening. This is what registered on the opening. Now this is kind of a marginal stock. I don't know why it's in my database because it's obviously not a very high price one, and today is not a very interesting day. But I thought I would just at least show you as an example. Yesterday and the day before by far were the interesting days. Let's look at this stock. This was up there as well. So you can see again that goosing, that first 15-minute reading came right up here, and this is pretty typical that you get that early drive off of the first 30 minutes. So yes, it's what's going to be the most urgent increase in volume, increase in range expansion, and those are the cases where you can go in and do a little bit more scalping. Now, remember what we talked about. You might only get one or two good technical trades, all right, because you're going to get tired, and the morning session wears itself out pretty quickly now, and so just be conscious of that. Look at yourself. Look at your own performance. Look at when have been those times where it's felt really great that you caught a big fish and you held it throughout the day and you experienced that trend day feeling. And that's really what you want to strive for, as opposed to, yes, there is validity in looking at little 5-minute buys, sell divergences, and so forth and so forth. I particularly like to trade in the direction of this 120 minutes. So this is my main roadmap, this 120-minute chart. But you can see here, it's still very noisy. It's not perfect little swings. And see all the little jagged hooks and crooks in the oscillators. And that's going to persist and continue to get worse in these types of markets.
All right, so, Linda. If you don't mind, Linda, I'm going to have to go ahead and wrap it up now.
Okay, so summarize. Trend for the day. If you had a low to high day, I'm looking for that high to low day. I'm looking for that first change in the opposite direction, and I'll respect that, okay? And if you're just breaking down from a line, remember Taylor what he said, let it run 5 days before you start looking for that counter trend swing on that 120 or 240-minute chart. And always go back and see where your bad trades or your losers were coming from, and ask yourself, was it because you were trading opposite that trend off that 7 a.m. reading? And a good part of the time, myself, I find that that's where my losses will come from, stepping in and trying to make a counter trend trade right that's not going to yield me much. Thank you again so much. I hope you gave you some things to think about, and best luck in your trading. I have to say that, as always, these markets never cease to surprise me with their continued glorious volatility and bountiful opportunity in just about every sector across the board. So there's plenty of year to go. I'm not doing any teaching or selling any products or doing anything for free, so I'm speaking strictly from my heart to you, and I wish you the best in your success for the year. Thank you.
Linda, thank you so much for being here today.